Well, everybody's having a good day today. This is Jeff Benson coming to you from Jacksonville, Florida. Today, we're going to talk about builder's risk again, my favorite topic. This is an ongoing series of webinars we've been doing for a while. I think hopefully you're all finding them useful. We try to keep this very up to date. These are the things that we're seeing every day, so they're very current in the marketplace. And so we're always thinking about new ideas, and this one's kind of revisiting one that I thought about a while ago. But what I'm going to do today is walk you through, and it's funny, in the insurance business, everybody has a different term for things, but we'll call it the standard, easy type risk, and we'll walk it all the way through to the more complex risks that we look at in our program. And so just keep that in mind. So, what we're really dealing with more here is the standard marketplace. We're not going to really handle the excess and surplus lines that some of you might get involved in. Yesterday, I had a $150 million frame apartment complex being built in Maui. That's what I call not a standard risk, right? That's excess and surplus lines. So what we're going to talk about in our program is the smaller values, the stuff that's being built all around. But even within that, there's a lot of nuances as far as the standard versus the complex risk. So without further ado, let's get into this a little bit. And keep in mind, this is recorded. We placed this, the hard copy, the PowerPoint on our website. I think this one will be a good source for you going forward. And as always, any questions, hold them to the end, and we'll do our best to answer those for you. All right, the basic builder's risk submission. We're going to go through this pretty quick because I think a lot of you are becoming experts now because you're attending all these webinars. But if you really want to think about this, this is the old acronym that property underwriters love to talk about: COPE, construction, occupancy, protection, exposure. So these are kind of the steps, and this is all the information you're going to need. So let's say we have a $1 million frame home, ground up new construction in Columbus, Ohio. It's being built. What do you need to get that thing quoted and written? This is all you're going to need. You're going to need to know frame, $1 million, Columbus, Ohio, protection class 3. I want a $1,000 deductible. I need to fill out some basic information on the builder. And let's just say that everything else is fine. You like the built-in coverages. That's all you need. Here's your price, hit a button, got a policy. That's as easy as it can be. To give you an idea, we had an agent in Tennessee that did 23 policies in an hour. So they did 23 homes under construction, individual policies, quoted them and bound them and issued them in an hour. So that's pretty good. And these are, so this is all you're going to need. We don't want to over underwrite this to death. We did an entire webinar on protection class. So I'm not going to beat that one to death, but that is a key rating factor that most carriers want today. So we might revisit that in the future because it does seem to be a lot of questions on that. But other than that, that is as easy as it gets. You should be able to place those very quickly. It is interesting too that I ask agents all the time, what makes you choose one program or one carrier over another for this easy stuff? And easy seems to be the word. You're like, I don't want to spend a lot of time on a small premium account that doesn't generate a lot of commission. I don't want my staff spending a lot of time on that. So some of this is just the path of least resistance. So one way you evaluate carriers is how many questions do you ask? If somebody's asking 50 questions to get this thing done and the next carrier asks 35, I don't know. I think the 35 question carrier is easier. So that's one way to evaluate that. I don't want to say that's the only way though, because there's still this thing called a coverage form. And there still is a difference, major difference in coverages. We've talked about this a lot. So even on these easy, slot-driven, template-driven, flow business, targeted business, whatever you want to use, you need to think about the coverage form. Because the way you're going to evaluate this is all those automatic coverages that are built in for no additional cost. So keep in mind, you do still need to look at the coverage form. And pricing probably has something to do with it. So look at the base rate. These are mostly driven by a base rate. So you want to look at that. And lastly is commission. I would say maybe you look at it in that order too. I don't know. I mean, that's up to you. Easy doing business, coverage, rate, and commission. So that's basically how you're going to evaluate all this. Now, I will say, managing a program like I do, what I'm looking for is an agent that's going to give me this business, and then every once in a while they're going to have a more complex risk, and I'm going to work on that for them. But we've built this base up of all this easy stuff, because that's what we really want to write. This is the easy stuff for us too. We don't want to spend a lot of time on it. If you send us a half-filled out application and we got to go back and forth 10 times to get the right information, we're all losing money. So we got to make it easy, not only for you, but for us too. So keep in mind, that's what's kind of driving this. So that was ground up new construction, $1 million. Guys build the house in Columbus. That's fine. We love that. The next level of complexity is the renovation project. And we've had webinars on this, but that in itself adds complexity. So now we have two different factors. You have the existing structure that you're going to cover, and the renovations that you're going to put into that, the remodeling expenditure you're going to put into it. So what most carriers do, and we do too, is we have to attach an endorsement to the form that allows us to cover that existing structure while it's under construction. This is not a vacant property program. It is a builder's risk program. So you need to understand that. So we have this existing structure and the renovations, and the complexity in there is the very first question we put on this screen. Description of the work to be completed. Any carrier that writes this business is going to know basically what are they doing to the structure. Are they simply putting new shingles on the roof and painting it and putting some new floors in it and reselling it? All right, that's fine. Are they simply putting in some new windows and maybe replacing the doors, doing some minor structural stuff? Okay, that's fine. Or is the roof rotted and now they got to put a new roof on it? The roof structure has got to be replaced. Maybe they're adding square footage horizontally, vertically. Maybe they're putting in an elevator. That's considered structural remodeling. That's very complex. So these things go from the simple remodeling renovation project to the more complex one. The things that you're going to run into that are a little tricky on this is, number one, what is the value of the existing structure? You have a 50-year-old frame building in Cincinnati, Ohio. What is that thing worth? All right, so pretty much what they paid for it. That's the market value. So that doesn't really a lot of times tell you that much. So what you need to do is come up with, in most cases, the actual cash value of that building, which we know by definition is replacement cost minus depreciation. So what in the world is the depreciation on a 50-year-old frame building? That's negotiable, put it that way. So the way we handle it in our program to try to make it simple is we're going to talk to you about that, and we'll come up with maybe it's a 50% depreciation on the replacement cost. And then we're going to write what we call a stated amount value. We're going to attach an endorsement, and we're going to write that structure for stated amount. Takes away the guesswork. Basically, we are saying as the carrier, we agree with you, this is the value of this building. So we shouldn't have a problem after that. So just getting that stated value, the right value on the existing structure is critical. And then the renovations are whatever the renovations are. Age of the structure. I get asked that all the time. Do you have a limitation on how old of a building you would write? Well, I wrote one the other day that was 250 years old. So we really don't have a limitation on age. We are going to ask, the big question is it a historical designated structure, or is it in a historical neighborhood? Because that does change everything. Once it's designated historical, then we have to start really looking into the values. We have to look at, is the builder qualified to work on that historical structure? So we have to ask a lot of questions on historical, and a lot of companies won't write them at all. We will entertain them. We're just going to ask questions on that. And then the last thing on a renovation project, are they going to occupy it while they're building, doing whatever they're doing to it? So that does add a level of complexity. We wrote a gymnasium that was being added onto a school, but the school is occupied while they were doing that. So it doesn't mean you're not going to do it. You're just going to have to make a charge for that. And you do have to modify the form to make sure the occupancy is included. So all these things just show you that ground up new construction is easy, and remodeling renovation is the next level of complexity. All right, so the way we do it in our program is we have one rate and basically one set of underwriting guidelines for protection class 1 through 8. And to give you an idea, I looked at the map of the United States the other day, and about 90% of the United States is protection class 1 to 8. About 10% is still protection class 9 and 10. What that means is there's certain factors that ISO uses to have a protection class. And if you're a 9 or a 10, it means a couple of things. It means you're probably over 5 miles from a responding fire department, and you probably don't have any fire hydrants within 1,000 feet of the structure being built. And the last piece is maybe the flow. Maybe they have inadequate flow rates, so that would cause that to be a 9 or a 10. And all of a sudden, once it's a 9 or a 10, it's deemed to be unprotected, and it adds a layer of complexity. So we're going to ask, how many miles is it to the fire station? Is it a manned fire station? Is it a volunteer fire station? We're going to need to know that. Are the fire hydrants installed yet? Are they even turned on? Are they working? These are all the things. And then we will ask, even if it's a 9 or a 10, we might ask the source of the water. And then, to make sure that the volunteer fire department that responds does have a pumper truck and they can pump the water out to put the fire out. I do find that interesting though, because a lot of that 10%, 9 and 10 around the United States is in the mountain areas, be it in the, the East Coast mountains or the West Coast mountains. And what happens on the top of a mountain in Colorado in the winter? A little bit chilly, right? So whatever source of water they have is probably frozen. I don't think they can throw snowballs at the fire and put it out. So that's why the homes they're building, we get these submitted every day. We had a $20 million home being built in Colorado submitted to us on the top of a mountain. So you can imagine, to me, that is not a standard risk. That is that's a lot of risk, a lot of values in an unprotected area. Another part of the country I find interesting is Southern California. We have this little thing called brush fires out there. Los Angeles, the community is a protection class 1. You can literally go a half a mile from where it's a 1 and it's a 10, simply because now you're going to be building this monstrosity of a house next to the desert out there, next to the hills. There's no fire hydrants. So everything went from a 1 to a 10. I mean, I've seen it. Now that it happens in other places, but that's a good example of what could happen. So once it becomes a 9 or a 10, any property underwriter that understands the business is going to say, okay, maybe I can do this, but I'm going to ask a lot more questions. And here's some of the questions they're going to ask. They're just going to want to know these things. It is funny though, back in the day, I had an underwriter ask me, how many helicopters are there in the area? And I was like, I don't know, I've never counted the helicopters, but that was one way of putting out a fire, right? So it is interesting. So what do you do in 9 and 10? So usually what you're going to see is the rates are going to go up dramatically, capacity is going to go down, and you just have to work with the underwriters to place those unprotected risks. So hopefully that gives you a little insight into what's going on. The next thing that we see every day, and I'm seeing it more and more, so that's telling me that the market, the capacity is restricting, is high valued frame. In our program, we can readily write up to 5 million per policy. We can maybe in certain inland areas go to 8 million on certain occupancies, but we're talking about the 20 to 25 million dollar frame apartments that are being built, and then we see a lot of them being built in the Southeast. But these things generate a lot of exposure. I live in Jacksonville, Florida. Last month, probably within a mile of where I'm sitting right now, a $50 million frame apartment complex burned up, all in a few hours. It was almost done, almost completed. They still don't know how the fire started, but it started and it burnt the building down, burned it all down. So, and even multiple buildings, if they're right next to each other, once the fire starts, we have a problem. So Houston, we have a problem, no pun intended. So what we're going to ask on the high value frame are things like this: firewalls in construction. So you have a $7 million home being built. We know a single family home doesn't have firewalls. Usually just doesn't. But maybe you have a $7 million Hilton Garden Inn hotel being built that's framed, and by code that has to have firewalls. So these things make it a better risk. So that's one reason we're going to ask about the firewalls. The occupancy does matter about what this is going to be, especially if it's going to be occupied while they're still building it. We have to ask that question. Something as simple as a construction manager that's there every day. We've had some webinars on this, but these things are the hot spots that are created during the course of construction during the day. If you simply have a project manager that walks the job site at the end of the day, you can save millions of dollars of claims, just the way it is. I mean, the apartment that burned down a mile from here, the fire started in the middle of the night, so as long as it's not arson, I don't know, but chances are it was somebody left something plugged in they shouldn't have, or maybe they were doing some welding. People are always doing some welding and they, something was smoldering and they forgot, they just didn't check it. It happens every day. So it's all about checking for those hot spots. It's critical. And then I'm sure on the high valued ones, some carriers now are demanding safeguard warranties. You have to have security guards at night, lighted, fenced. It does add a lot of value, a lot of cost to building these things, but the rates that I'm starting to see on this high valued frame they're astronomical. I used to see rates of, well, going back in time, you'd always say maybe 35, 40 cent rates. Then it went to 25 cents, which was too low. Now I'm seeing 50, 60 cent rates on these projects. So there's a lot of exposure in the high valued frame. And the other piece of this is they build these high valued frame stuff. Where are they building them? They're building them in coastal areas. So you have windstorm problems too. So they're going to ask a lot of questions about that. When are these things going to be capped and how much value is going to be there during the wind season? How many wind seasons is this project going to go through? Structural renovation. This is another level of complexity that adds a lot to this. Simply, now we have somebody that's, we'll start with the minor ones. If all they're doing is doors and windows, replacing the shingles on the roof, ground floor additions, they're adding horizontal square feet, electrical, plumbing, AC, sometimes depending on what AC work they're doing. A lot of that stuff is minor. Underwriters don't get too excited about that. You can probably get a pretty good price for that. Where you move into another thing though is major structural changes. Now they're replacing or repairing or adding load-bearing walls. They're adding additional vertical square feet. Stairways and elevators are always a key to structural stuff. Foundation work in the Northeast, you see a lot of underpinning that goes on. We have a lot of projects. You have a row house, you have 4 houses in a row connected, and they start digging underneath the house. We have a problem. Now, from a builder's risk standpoint, I'm not that worried if they collapse the building next door because I'm not insuring that. That's a GL problem. But what that means is anytime you do underground work, underpinning foundations, you've increased the chance of a collapse. And we have had several large collapse claims in our program in the last couple of years. Usually what I see on that is when you have a contractor that's never done it and they go, yeah, I think I can do that foundation work. That shouldn't be a problem. And even though they've never done it, that's really the problem. So a lot of underwriters really, the number one thing they're going to do is underwrite the builder to make sure they know how to do it. But what they're also going to do is make sure that there is a certified structural engineer that's looked at this project and deemed it to be structurally sound and they know what they're doing. So we're going to have that if we're even going to entertain these structural changes. And I've seen some crazy stuff that they're doing now. It's amazing. And I guess if it's a historical building and they want to maintain the architectural design of the building, that's what they do. That's why they do these things. So you do see a lot of that. So I will say, as far as our program goes, the minor structural is not going to be a problem. The major structural, we will entertain it, but we're going to ask a lot of questions. And so you got to give us some lead time. Going back to some of the historical it's really, once again, underwriting the builder. But what has the builder done in the past? Most of these, you got to give us an idea. Now, sometimes you can go to the builder's website and it shows past projects or ongoing projects. And you get a pretty good feel for, yeah, this is a builder knows what they're doing. But sometimes you go to the builder's website and all they've ever done is build single family homes. And now they're building a multi-story apartment complex. You kind of scratch your head and say, How are they doing that? So those are the kind of things we're going to ask. The other thing about all this renovations talk too is really the scope of the project. What are they doing? You have to, as an agent, understand the scope of the project. So we're telling you, spend a little time with the builder, understand the project. And on this historical stuff, there's historical tax credits. We wrote one of these the other day, and the premium on the historical tax credit was very, very high, but it was an exposure they wanted to insure. So that is something we would entertain. And I could probably do a whole other webinar on that, but just keep in mind the historical tax credit is an exposure that is insurable if you're doing historical properties. And once again, all of these optional coverages and automatic coverages come into play for these more complex risks. And just by adding these coverages, you've added complexity to the project. Flood, quake, soft cost is a big piece of this, delay in completion. So as you add these coverages to any standard risk that might become more complex, you're going to have to answer more questions. You're going to have to understand the coverage form, the waiting period on soft cost and things of that nature. Waiver of subrogation. We have some contractors that do a lot of work for Walmart. So we have to waive subrogation against Walmart. Kind of adds layers of complexity to that. So this is just to give you a taste of taking something that's very simple, $1 million ground up new house being built in Columbus, Ohio, to major structural renovations on a historical building in a coastal area. And they want flood coverage. So, I mean, that's the layers of complexity that you might be dealing with in builder's risk. So hopefully I gave you a little taste of this. What I'm going to do now, we got a few minutes left, and we're going to open it up for questions.
All right, Jeff. So the first question we've got is, can you clarify what hotspots are in reference to inspecting for hotspots at the end of the workday?
I like that. So this is one of the easier ones I'll get today. So a hotspot is just that. We had an example of a claim that we had, one of our war stories, where a subcontractor, the roofer, left a light bulb on because they were using this high-powered metal halide bulb to heat up their glue. Well, they simply left the light bulb plugged in, went away for the night, started a fire in the night, and burnt the whole building down. That's a hotspot. And like I said, a lot of times it's welders, plumbers doing a little welding. Some of the solder falls down into somewhere, starts smoldering. Nobody checked for it. We had another claim in the Pennsylvania and Philadelphia area. They left some Christmas lights on, of all things, and the bulb got overheated, and the fire started inside the wall. They didn't know about it till the next day. Caused a lot of damage, a lot of smoke damage. So it's just simply a hot spot, can be created by a number of different reasons. We need people to walk around the job site at the end of the day and look for them. Good question.
Okay. What is the historical tax credit coverage? Does the policy pay if the credit is not awarded?
Yeah, I'm not going to go into detail because it is pretty complex. I don't even have enough time. You guys would probably put you all to sleep. But yeah, that's what it is. You have a tax credit because you've agreed to do this project to certain standards, and something happens and you don't realize the tax credit. It either wasn't done on time or does right. So it does. That's how it pays, and it's an expensive coverage, but people do want to insure it.
All right. Can you do builder's risk in coastal Florida and include wind?
We do write business in Florida. I think it's our second largest state premium for our program. And we do write the wind depending on where it's located in the state of Florida, depending on the construction. We have certain guidelines, but we do have capacity in Florida.
Super. And can you explain what the term cold testing refers to?
All right, so let's start with, I'll walk you through all of the testing. So first of all, our form is pretty broad. We build in automatically testing of building systems. So that means you're building a house, and now they're going to test the electrical, the plumbing, they're going to test these things. Testing the building systems is built into our form at no cost at all. Okay? But now let's say you have a boiler and the boiler is going to be used to heat this building, and you're going to hot test that building, that boiler, you would need testing coverage for that. Now, even a better way to cover this would be equipment breakdown, which we do have now. So equipment breakdown is even a broader coverage than boiler and machinery. And that's kind of where the industry is going. So I think kind of solve it all. You know, the first thing I would do is if you think there's an exposure, you need to request equipment breakdown coverage. And it's not really that expensive. I usually see it for around a penny per 100 of values. So it's something that we do. Some markets do it and some don't, but I think it's a good coverage.
All right. Can you add the builder or other vendors as additional insureds?
Absolutely. And builder's risk, you have really two entities you're dealing with. You have the builder, or you have the owner, investor, or developer. You know, and what I would always recommend is that you have both of them on the policy. One as an insured, one as an additional insured. So both parties are on the same policy, makes it for a lot better in the event of a claim. So absolutely. Usually subcontractors, and on our form, the interest of subcontractors is automatically included, so you don't have to add them.
Okay. When would you refer an electrical sub to obtain a complete builder's risk as opposed to using an installation floater?
Good question. You know, I mean, you could always argue that if you're insured as the electrical contractor and you want to make absolutely sure that their interests are protected, then you can write an installation floater for that electrical contractor. You know they're covered then. But chances are, if they're working for a reputable general contractor, you know, the coverage should be on the GC's policy. And I would verify though to make sure, because let's just say, you know, the electrical portion of a job, especially a commercial project, can be substantial, millions of dollars. So maybe the best bet would be to ask the GC for a copy of their policy. You know, if you're protecting your sub, maybe that would be the thing to do. So, I mean, either way, I mean, I've seen, you know, I do installation floaters for subcontractors if that's what you want to do. That way you can make sure that the transit coverages are correct, you know, and all of the property exposures for my insured are protected. So it's really up to you. Are we still there? Darcy, did I lose you?
Do you hear me, Jeff, now?
I can hear you now. Yeah, I lost you there for a minute.
Okay, lost me there. Are you able to insure a building that will be demolished?
Yeah, I find that interesting. I always get asked that question, and I'm like, well, what do you want me to insure it for? You're going to tear it down. So, I mean, they're really, sometimes the lending institutions in their infinite wisdom will say, you've got to write a policy for the value of the building being torn down and the new building. Well, I've actually done it before, because there is the existing building that's being torn down on our builder's risk policy has no value. So if you put it in there, there's no coverage, but sometimes the banks makes them feel better. So I guess what I'm saying is, if it's absolutely necessary, you can add the value in even though there's no coverage, because there is no value from a builder's risk standpoint. Good question.
All right. Can you address pitfalls in debris removal in large structures that are being converted into warehouses?
Pitfalls of debris removal. Okay, let's think about that one a second. So we've written the builder's risk policy. Debris removal, I usually think of happens after we've had a claim. So if we're talking about just the ongoing construction operation, I guess I'm not really clear on the question, but I would take a stab at that. I mean, once again, the experience of the builder. You know, if we got a builder that's used to doing these type of projects, we do see a lot of things being converted to residential, mostly in the urban areas of the Northeast. You know, they're going to take a warehouse and make condos and lofts out of it. So you probably do have to remove a lot of the stuff that's already there. So, I mean, to kind of keep it simple, it better be a builder that's done it before. Because I could see, what if they move a load-bearing wall by mistake and collapse the whole building? That is the biggest problem we have with build outs is collapse. Existing buildings collapse. It's interesting when you look at builder's risk as a whole. We went over this a couple months ago, but fire is the #1 problem. Frame buildings burn down. Second problem is windstorm. The wind blows these things down. But then as you get past fire and windstorm, you start looking at things like water damage that happens to buildings, and you definitely have collapse problems. So it's in the top 5 of all the claims we worry about. So hopefully that helps.
Okay. What information do the brokers need on builder's risk for new construction?
That was that first screen that I showed. It's on there, but all you need for new construction, depending on the values and where it's located, you just need to know the value. You need to know the construction classification, the protection class, and the deductible. All you're going to, and most carriers are going to want to know, it's John Smith Builders. He builds houses. He's been doing it for a couple years. Everything's fine. So very basic information on ground up new, lower valued structures. Think about the COPE: construction, occupancy, protection, exposure.
All right. Let's do a few more questions.
Okay.
If you're working with a general contractor doing fixes and flips, are there any specific coverages that you would recommend to cover coverage gaps?
The most misunderstood coverage in our line of business is delay in completion. And so you really need to sit down with the contractor and get a feel for that. You might have to do, it's almost like an accounting worksheet to calculate their soft cost, to calculate maybe rental reimbursement. There's just a lot of things there. I think there's a lot of exposure that goes uninsured or it's incorrectly insured in the delay in completion world. #1, I see that happen a lot. #2, back to the basics, is just the value. If you're writing renovation, remodeling contractors, spend a little bit of time on the insurance to value to make sure you have it correct. What is the existing structure worth? And what is the renovations being put into it? Everything we do is completed value builder's risk. There is a co-insurance clause built in, so you need to get it right. And that just means talking a little bit to the builder to get a good idea of what is the value that's sitting there. Plus, the idea of insurance is to make them whole again, right? We don't want to profit from it, but we don't want them to lose anything either in the event of a claim. So insurance to value is a key. Those are the 2 that jump off at the top right there.
All right, Jeff, let's do one more question. Last one. So when you're discussing high value frame, are you saying that you will only insure up to a specific dollar amount?
Right. In our program, our capacity, for the most part, is up to $5 million in frame. Now, we do have a little leeway. I could go a little higher depending on what is being built and where it's being built. So you could say we have limited capacity up to $8 million frame, but that's as high as we can go. What I'm seeing is there's a lot of markets that are restricting their frame writings now. So it is becoming more of a, basically, I think it's kind of heading towards excess to surplus lines, and you're starting to see layered approaches. I even had a broker the other day tell me it used to be he'd put together a high value frame project and it would be 3 layers, 3 different carriers. Now he has 6 different carriers and 6 layers. So it gets pretty complex. And we're not really a market for the layered approach on frame, but I find it interesting. So if you want to call and talk to me about it, if you get one, I do talk about it, but it wouldn't really be for our program. We focus in on that 5 million and less. Now we also, if it's any other construction, joist masonry, non-combustible, we can go to 25 million. So we can go much higher on the non-frame stuff. And we have very competitive rates on the non-frame stuff. You're looking at the difference in rates now from frame to masonry non-combustible. Sometimes frame is 25% of the M&C rate. So much different rating factor. People ask me why, and I said, well, the concrete and steel buildings don't burn down as much and they don't blow over. Pretty simple, right? Good question.
All right, Jeff, we've still got a couple more questions, but we are over time. So for those of you who didn't get your question answered, someone from our team will be reaching out to you.
Yeah, here's my contact information and Donna's contact information. And we're all over the Victor website. We'd love to hear from you. If you have questions we didn't get to today, you can pick up the phone and call me or email me. I greatly appreciate your time today. And we're always asking for new ideas. So if you have anything else we want to go over in the next webinar, let us know. And we'll do our best to work it in. But everybody have a great day and let's go write some builder's risk. Take care.